Hello traders, Gary Wagner here. It is 12:30 in Honolulu, 6:30 in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 20th day of September 2024, and this is the evening report for gold and silver, our weekend review. Over the last couple of days, in fact the last 2 weeks, gold prices have soared to unprecedented levels, today setting a new record high and closing price. Today's surge is attributed to a perfect storm of geopolitical factors and the Federal Reserve's recent monetary policy shift. Gold gained $35.40, basis the most active December contract, taking December gold to $2,647.10, just off of today's high at $2,651. Silver gained 39 cents in trading today, taking the most active December contract to $31.49.5. And the strong gains in both gold and silver easily overcame fractional dollar strength. The dollar gained 0.10%, taking the index to 100.801. This first chart is a 30-minute candlestick chart of December gold. We are looking at the strong rallies that occurred yesterday as well as today. Both days had strong upside moves, and I want to compare this candlestick chart to a standard Heikin-Ashi or Japanese average chart, because what it indicates is the strength of the trend over the last 2 trading days. Very large candles during price ascents with no lower wicks here, and here on both days, which indicates that the strength was dynamic throughout the trading session on both days and could likely continue into next week. On yesterday's show, I talked about my most recent revision to our technical study, specifically our Elliott wave count, with the assumption that because of the dynamic move over the last couple of days, we could see gold trade higher during the primary third wave than a 1.38% extension of wave 1. We have 2 basic extensions on this chart, one in red and one in black. The one in red measures the distance of wave 1 from 2357 up to 2523 and begins at the conclusion of the primary second wave and ascertains different projections as to where the third wave could terminate. At first, we were looking for a minimum of a 1-to-1 relationship, which would take gold to $2,565 if wave 1 and wave 3 were equal. That's based upon the Elliott wave rule that wave 3 cannot be the shortest. We were under the assumption, once we had this large spike up, that more likely we would see it travel higher, and we projected a model based on a move of 1.381, but we took that out today, which means that most likely we could easily see gold trade to a 1.618 extension, which we could see occur next week, taking gold to $2,665. Our model then calculates the corrective price move if gold reaches $2,665 and has a shallow correction of 38.2%. The reason we are anticipating a shallow correction is because wave 2 had a deep correction, and in Elliott wave modeling, we look for one of the corrective waves, either 2 or 4, to be shallow and the other to be deep. If that would be the case, once gold reached $2,665, we could see it correct to $2,566. On yesterday's show, we looked at where that would take a final primary fifth wave, and we projected $2,730 based on a 1-to-1 relationship between wave 5 and wave 1. However, on today's show, we want to add another variable or potential for the fifth wave, an extended fifth wave, which we have seen in gold on numerous occasions. If that's the case, gold could travel higher than $2,730, possibly as high as $2,800, based on a 1.38% extension of wave 1. The fact that gold has risen approximately $120 in the last 2 weeks caused us to yesterday update the upper level that we are looking for the termination of our primary third wave, and today suggests an alternative ending, which is an extended fifth wave, taking gold to $2,800 per ounce rather than $2,700 per ounce by the end of the year.
After the Fed Chair Jerome Powell announced a 50 basis point rate cut on Wednesday, both precious metals, gold and silver, had a dramatic decline on the day. However, that whipsaw seemed to be nothing more than a blip and did not cause any chart damage or change our projections. We are still within our wave 3. I believe our wave 3 still has quite a bit to go, and let me show you why I believe that. Below, I have just added our MACD. If you look to our previous impulse cycle, notice that in our first wave, our MACD had crossed above the signal line. However, both averages were beneath zero and in negative territory. That changed when we went into our third wave. In our third wave, we not only had a zero line crossover, but we had our MACD start to widen the gap between the two averages, both of which were moving up. We had our signal and MACD line go all the way up effectively to 1.138 for our MACD line. That's right around where our third wave terminated. And our fifth wave was also very strong. In fact, we got the exact same reading of 1.138 at the termination of our fifth wave. So now let's take that over to our current impulse cycle. We had our MACD line above our signal line, but both were below zero, just as our first wave in our last impulse cycle. In our third wave, we have crossed the zero line, and now the distance between the two is growing, meaning we are getting a divergence in the MACD, just as we had back here in our third wave of our last impulse cycle. And because we are still at such a relatively low value in our MACD, I think we have much further to go before our third wave terminates. I think that we could easily be testing these highs that came in around May at around $33. On Wednesday, we made a loose trade recommendation to go long silver. Traders who took that call should have gotten in around $29. And earlier this week, we made a recommendation to raise our stops to $30 or just below $30. Luckily, the whipsaw action that occurred following the 50 basis point rate cut did not stop us out of our trade, as the low was 3 cents above $30. So those traders should still be effectively long the market. And I think it is also time to raise stops for a second time. Traders that are in this trade should raise our protective stops from below $30 to right around $30.40. That is matching up with this top here, and it will lock us in some more profits. If silver acts as I believe it will, we should get a series of higher lows and a series of green candles continuing at least for the next couple days. So we shouldn't have any issue with that stop. Our target now is firmly around 32.90, which I believe we may reach by the end of next week.
This has been Gary Wagner,
And Joseph Wagner.
wishing you, as always, good trading. We'll talk to you next week for the next evening report. Bye-bye.